Welcome. It's good to see you.
Good to see you.
You say it's an eyes wide open market. What does that mean?
Well, there's so many different things happening, both domestically and then geopolitically, and then from an innovation standpoint, along with now policy and tax changes and deregulation, that the head fakes are going to be abound. And my encouragement is investors really just stay focused on earnings momentum and the attributes that contribute to earnings, which is different than trying to trade policy possibility.
Aren't we doing that now, though? Aren't we kind of trading policy possibilities and probabilities, tax cuts, tariffs, deregulation? That's what this whole rally has been based on, the idea that all of those, you're going to have re-up tax cuts, you're going to have deregulation, you may have tariffs, but we've been trading that.
Right. So trades, so I would agree that we're in a trading market right now where these bumps, this 6 to 7% bump isn't necessarily based on earnings, although the other 27% that we got year to date was based on earnings, so that's pretty good, which means that policy volatility is what people should expect, which is different than earnings momentum, which is also why stock selection, rebalancing, and having your eyes wide open in terms of where you're investing in the pockets that will be more enduring than just sort of a fadeaway.
Okay, what are those pockets? Because we went from a mega cap tech dominant market to a little bit of a pullback, and then the rest of the market got its act together. And now I feel like we're potentially at another inflection point. I'm not sure what to make of the fact that you have the resurgence in tech. What do you make of it? As you say, we're in a not-to-miss industrial revolution. That tells me you're focused on tech.
Focused on tech. So if you go back to 2023, that market was 10 stocks. 2024, we got 40% of the S&P, so we got a bit of the broadening. 2025 is going to be a broader broadening, but the difference is that we should start to see companies that aren't already positioned for the download of AI are going to have to play rapid catch-up. And that's what I mean by sort of these corporate extinction events that harken back to the early 2000s. It's going to be very hard for companies to catch up, and we're already seeing that as an example in some of the companies within the chip sector.
Do you like sectors and stocks outside of tech? Because I guess in some respects what I hear you saying is, I like tech, but I don't have to be all focused in the mega cap.
No, well,
I like the derivative plays.
The derivative plays, because AI is an equal opportunity installation across all business cycles. That's the difference between this moment and 2001. And that's why I think the opportunity is so big, because we're installing a technology and proven business models that already takes current earnings and improves them, expands them, and reduces costs. It's a very different kind of industrial revolution than the uncertainty of the early 2000s around what the internet was going to be in this economy. Very different.
You like staples in healthcare. Healthcare is the worst performer of the year.
I know.
You don't believe that's going to continue?
No, I don't. Just like in the first part of the year, the financials were the worst performer to start the year. And at one point in January, we were down 8%, and people thought we were going to have a recession. We were not in that camp. And now financials are one of the best performers, and I believe that healthcare will have that catalyst.
Okay.
It'll be too hard to time.
I was going to ask you that, and that was the word I was going to use.
Yeah.
The catalyst for financial stocks is obvious, right? Good economy, deregulation, more deals, pipelines, pent-up demand, blah, blah, blah. You go on and on and on. It's obvious to see why those stocks have done well. What is the catalyst for healthcare?
Well, it's cost reduction, number one, just in terms of the ability to use AI at the white-collar level to get to the same analytic outcomes, especially in vaccine development, as an example. And remember, too, that healthcare stocks and pharmaceuticals and biotech in particular are driven by the ability to get approvals, and that sausage making takes a little bit of time, but it sort of produces a J-like type return. So we're getting a good dividend, and I think it's an important part of a portfolio, but our overweights, though, continue to be in tech and financials and industrials. Net
for the S&P next year, what kind of return do you think is reasonable? What do you have in your own mind?
Well, I think we're double digits for sure in my mind, but I don't think it's a straight climb at all. Just like, every single year, Scott, the market starts the year at some point lower. It's lower at some point during the year than where it started. So we have a guaranteed intra-year decline. And I think given the policy and political volatility, we could see even a greater level of peak to trough volatility. So it won't be a straight line, but it'll be an opportunistic market for people to end the year in a positive territory.
This has been a crazy year. We got close to a 10% pullback, but we didn't get quite there. And it was one of the longest periods without one. It's good to see you.
You too.
Enjoy the weekend. Sherry Paul, thank you.